Hey guys, this is Claudia here from the Bookkeeping Experts. I'm back for one more week of education with QuickBooks Online. Today we're going to talk about the chart of accounts. How do you organize it so that it can make it easier for you to read your financial statements? Now keep in mind, the chart of accounts is the heart of your QuickBooks Online account. And if you don't correct it and organize it, your financials will not be correct or maybe disorganized. So wanted to go over with you a few things, and then we're going to show you how to add accounts, how to make inactive, and how to clean it up so it can look just the way you need it, so you can present your financials in a professional and clear way. All right, so without much further ado, we are going into QuickBooks Online right now, and this is the chart of accounts. How do I get there? You can click on the top right hand side gear menu and then select chart of accounts right here, or you can click on transactions and chart of accounts right here. There's other ways for us to get there. Okay, so the first thing that you want to know is that the first accounts that you're gonna see in the chart of accounts will be your asset accounts. So the first accounts will be related to your balance sheet. The balance sheet it's what shows the liquidity of your business. We have a video talking more details about your balance sheet, but it's a way for you to know if you sell out all your assets and eliminate all your liabilities, what's the bottom line? What's your company worth after you liquidate everything? All right, so after the assets, you're gonna have another account from the balance sheet, which is your liabilities. And after the liabilities, you are going to have your equity accounts, and those are all your balance sheets. So start with assets, you have your liability, and then your equity accounts. Okay, so one thing that is very important, when you create an account, you want to make sure you create the right kind of account. If not, everything is going to go to the wrong report. So if you're adding an asset to your books, remember it's going to be an asset. It has to be an asset. If you add it as an expense, then it's going to go to your income account, and it's going to be miscategorized. Keep in mind that anything above $2,500 should be any asset that lasts more than a year, above $2,500, should be capitalized. What is capitalized, Claudia? Capitalized means that you are not going to expense right straight away. You're going to put it on your balance sheet, and your CPA will set up your depreciation schedule. So it's going to be depreciated over the year, depending on the life of your asset. It could be 5 years, could be 10 years, depending on the asset, right? And each year you're going to take a depreciation expense on your income statement or profit and loss, and a accumulated depreciation, which is a counter asset account in your balance sheet. Okay, so with that being said, wanted to let you know, as far as bank goes, you should have only the banks that are business bank. You don't want any personal account in your QuickBooks Online. If you add your personal account, that means you're gonna have to reconcile everything, and if you're ever audited, the IRS does not like you to mix business with personal. So very important to be careful not to mix personal with business. You may add transactions that you purchase with your personal credit card. We have another video on that, but you want to keep like the bank accounts at the minimum. And keep in mind, you will need to reconcile each of those accounts. Okay, so talking about assets. So first you have your bank accounts, then you should have inventory, and then any loans that you not loans that you given to others. Undeposited funds is also an asset account. We talk a lot about undeposited funds. It's an asset account to hold the deposit you're recording or the payments you're recording when the customer pays you, but at this point is not deposited on whatever bank account you want to deposit. So it's just a holding account. Prepaid expenses, it's also an asset account that should be in here. And finally, other uncategorized asset. Uncategorized assets should be at 0. Okay, if it's not at 0, you want to take a look at them and categorize them correctly. Hopefully, it's not a transfer, because if you categorize as a transfer as uncategorized asset, you're gonna have to, if you already reconcile, you're gonna have to undo that transaction and categorize it correctly. All right. So let's talk about, after asset, you have your liability, or your fixed assets, your counter asset accounts. So if you have a depreciable asset such as building or vehicle and things like that, you want to have a counter asset for each of those assets, and that is accumulated depreciation. And if it is an intangible asset such as goodwill, you will have to create amortization, the accumulated amortization account as well. So the counter asset is gonna, each year when you record your depreciation expense, you're gonna take it away from that asset. So let's suppose that your asset costs $10,000. It has a 5-year life. So each year you're gonna depreciate, you're gonna debit your depreciation in $2,000 and credit your accumulated depreciation. If it is goodwill, you're going to do the same thing. So you're going to credit your amortization expense and debit your accumulated depreciation or amortization. I apologize. So with the amortization or depreciation, keep in mind that it should be credit, means that it's taking away from the value of that asset, because that asset is gonna, each year is gonna go down in your books until it zeroes out. Zero out. All right. So let's talk a little bit about your liability account. Your liability account needs to be reconciled, and if you ever see a negative amount on your liability account, means that your account is overpaid. What does that mean? What does that mean, Claudia? So if it is a loan, for instance, and you see a negative 2,000, it means that you paid more than the loan, than you own the loan. And most of the time this happens because you're not recording the interest expense. Okay, and in that case, you will need to record a journal entry to debit your interest expense and credit your loan account. Okay. All right, so let's keep on going here. So that's your liability. You're going to have your current liability first. What is current? What's the difference between current liability and long-term liability? Current liability is anything that you pay within a year. Okay. For instance, if you are an attorney, a trust would be a current liability, because you're supposed to use that trust usually within a year, or pay that liability within a year. A deposit usually goes into current liability. So let's say that your client's paying you $1,000 to reserve your services, that goes into other current liability. And then once you provide the service, you take out of the liability and you record that as an income, right? Okay. So you have your long-term liability, as I said. So long-term would be any liability that is over a year. You're going to pay it over a year. It could be a mortgage. It could be a vehicle loan or equipment loan that is more paid for a longer period than a year. You will consider that as long-term liability. All right, an equity account. What is equity account? Equity it could be either anything that is personal, like let's suppose you're putting money into your account out of your personal funds. That's equity. It's owner's investment. It could be transactions that you use your business card for a personal expense, so you will record that as a personal expense on the equity account. Okay. And it could be in case if you were an S Corp or C Corp, if you have stocks, you will have that as an equity account as well. If you have stocks means not investment stock, but the company. If you have stocks in your company, that's where you're gonna be adding to. It's to equity. Okay. Like I said, any owner's investment or owner's distribution also goes into equity. Okay, so those are important accounts. And one thing that you want to make sure is that if there is any duplicated account on any of those categories, you want to make sure that you eliminate any duplicated account, because if you keep it duplicated, it just becomes confusing, and your financials are going to be confusing as well. Okay, how do you add or delete accounts? With QuickBooks, you're not completely deleting the account, but you're making it inactive. To add new accounts, you're going to click on new. Okay, and you're going to be able to name the account. And the account type is one of the most important things when opening an account. You want to make sure that you select the right kind of account. I've seen all kinds of errors. One of the worst is creating bank account to expenses and income. I've seen just about everything. And what that does is that, of course, if you're recording your expenses to a bank, you're not recording your expenses, period. It's just going to go as a negative asset. So you cannot use your books to file your taxes if any of those accounts are incorrect. You want to make sure you choose the right kind of account. Okay. If it is a bank account, then you will create a bank account. But if it is an expense, you want to make sure you categorize as an expense, and so on and so forth. If I'm going to select one of fixed asset, and under fixed asset, there are some sub accounts you can choose from. QuickBooks is already kind of giving you the options for fixed assets. What is fixed asset? Building, computers, copiers, furniture, tools, phone, photo, anything. Like I said, fixed asset would be anything that would have a lifespan of over a year, and you spend over $2,500 on that asset. Okay, of course there are exceptions. There's accelerated depreciation on those assets, depending on anything that the government is offering at the current year. I would advise to contact your CPA and verify if there is any option for accelerated depreciation, and if it is worth it or not for you. Okay. All right, so we learn how to add an account, and then if you see that there is duplicated account, how do you eliminate those duplication? Well, there's a couple of options. Okay, if it is duplicated, you want to add it and rename it exactly the same, and QuickBooks is gonna ask you if you want to combine those accounts. Let me show you an example of that. Okay, so I'm gonna create a duplicate account here. Long term, I'm gonna create a new, I'm gonna create a fixed asset and furniture, and I'm gonna put furniture 1 and save. Okay, I just duplicated because I have 2 furniture accounts. I just created the second one right now. I didn't need it, but sometimes you may. Okay, so we have furniture and furniture 1. Okay, this one is a sub account of assets and furniture. This one is not, but we want to make sure first that they're both the same. So this furniture here has a sub account of long-term office equipment. So before I do anything, I want to make sure that this is also a sub account of furniture. Okay, let's go back there. Long-term office equipment. Okay, there you go. That's the sub account. So now they both are sub accounts of the same thing, and I'm gonna fix it. Keep in mind that the spelling has to be the exact same thing. If there is any space, it's not gonna merge. If there is any space, misspelling, or anything like that, it's not gonna give you that option to merge. So this one, everything is the same, is also a sub account. So I'm gonna take this number 1, and QuickBooks is gonna show me here that there's another account, see, that is also furniture. And if I click on save, I'm gonna receive a little message that there is already another account with the same name. Now, keep in mind that in this case, I have a little difference here, and the difference is that here it says fixed asset furniture, and here it's furniture and fixture. Okay, so I'm gonna make sure that I fix the type of account before anything else. So it's good for us to have this difference so that you can verify. You're trying to merge it and it's not letting you. It's probably because the account type or there's a misspelling somewhere. So fixed asset, furniture, there it is. Okay, now we have the same type of account. Okay, now if I try to go into the second account, remove this one. Okay, I see that there's 2 accounts the same. I see that the detail type is the same. The spelling is the same. I'm gonna save it, and now I receive this message saying you already have an account with that name. Would you like to merge? Yes, merge account, and then you click on save. What's gonna happen? Now I only have 1. Okay, so that's how you merge it. So duplicated account, I would advise you to merge if you can. If there is a 0 balance, chart of accounts again. If there's 0 balance, you can go ahead and make it inactive. By the way, wanted to let you know, when eliminating an account, let me delete this furniture. To eliminate an account in QuickBooks, you want to make sure that you clear the balance first. If it is a 0 balance, you can go ahead and delete that. Now, a couple of things to know is that there are some required account in QuickBooks. Some of them are undeposited funds or payments to deposit, accounts receivable, uncategorized asset, uncategorized income, and uncategorized expense. Those are required accounts, so you will not be able. to this just delete. Okay. Another thing that is important to notice is that sometimes you may try to make it inactive, but it's going to give you a message saying you can't make this account inactive because there is a product or service that is associated with this account. Okay, so what QuickBooks is saying is that if you have a product or service that is routed to the account that you want to close, it's not going to let you. The first thing you need to do is to go on the left hand side, products and service, and look for the account. Now, if you have 500 different products and service and you're trying to find that specific one, that's kind of tricky. So you may have to run into a invoice or something like that, and you may be able to find it this way, right? To find on your product and service what kind of accounts being it's been routed to, you click on edit on the product and service, and under this income account, it's going to tell you what type of account is the product being routed to. Okay, sales. Sometimes it can be routed to different kinds of accounts. If you have a deposit that is refundable, you will want to create a product called deposit and route it to a short-term liability, which is depositable payables or deposits, client deposit. Okay, all right, so let's go back to our chart of accounts. All right, okay. So next thing, so after we edited all our liabilities and we clear all the duplication and we kept this clean. Now you can have up to 300 accounts in your chart of accounts, and for advanced you can even have more than that, but I do not advise to have too many accounts, because what's going to happen is that if you have too many accounts here, your financials are going to have multiple pages and it's going to be very confusing, and you don't want that. One common mistake that I observe is that some people will create an income account for each type of service you provide, or product, not service, but product that you provide. And that is completely unnecessary, okay? You don't want to do that. You want just to keep this clean. So you want to have maybe 4, 5, 6 here. Here we have a little bit more than that. We have 2, 4, 6, 8 account, and that's okay, because the 8 counting the 2 requirement accounts, which is unapplied cash payment income and uncategorized income. So there's 6 actual accounts, but you can eliminate that. You can keep this as clean as possible. We found a duplication right here. See, billable expense income 137. Let's eliminate that. So edit, everything is the same except for this number 137. So if I delete this 137 and I save it, there it is, the message that prompts you to merge it, and then you want to save it, and voila. So now I only have one. All right. A couple of things that I wanted to talk to you about the chart of accounts is that you can have sub accounts. And what is the sub accounts used for? Okay, so if you have a group of income that you want to view on your profit and loss as blocks, such as let's suppose you have consultation income, and maybe you have service income, or maybe installation income, and you may want to create sub accounts in those consultation. Let's say you want to divide it, let's say, into or business consultation versus residential consultation, and you want to keep this as sub account. To create sub account, I guess I already showed to you how a sub account work, but we're gonna create one for you. So we talk about consultation. Let's go to the income account. So we have legal fees. Okay. All right, so let's talk about legal fees if you're an attorney, right? So you want to create a new account, income. It's either primary, or you can select service fee income. And here I'm going to name legal. Legal income already have, let's say, criminal consultation income, and I'm gonna make a sub account of legal income. Okay, and let's suppose that I have another one that I want to track, and also an income account. It's going to be service fee, and let's say that here I'm gonna put I don't know, let's suppose you have different kind of section in your legal firm, and I'm just gonna put here, let's see, accidental legal income. You know, if you're charging the insurance, there you go. We're gonna make it a sub account of legal income, legal services. Okay, there's two things that is important for you to know when creating those accounts. One is that it has to be it has to fit the purpose. Means that when you look at your income account, you want to see the blocks according to your needs, or you want to track those income according to whatever is important for you to know. If you want to separate if you have a restaurant, for instance, you may want to separate catering income versus the restaurant income, and so on and so forth. Okay, so very important to have those blocks. And when I create the sub account, this is how it look on the chart of accounts. So you have the main parent account, and then you have the sub accounts. So one example is the long-term office equipment, and then you have computers, copiers, and so on and so forth. Anything that is related to that asset or income, or so on and so forth. You want to make sure you don't, if you have a fixed asset, you want to make sure that the sub account is also a fixed asset. So it's the same type of account. You don't want to mix an income account with an asset, and so on and so forth. You want to make sure you keep everything the same. Okay, you can create up to 5 layers of sub accounts. Do I recommend that? No. So once again, you want to keep your books as clean as possible, because whatever I have here will show up on your profit and loss or your balance sheet. And you want to make sure that it's concise and it's clear and it's easy to understand. And it fits the purpose of your business, you understanding your business, and it fits the purpose of giving it to your CPA or your accountant at the end of the year so that they can file the taxes. The most important goal for me always is to make it simple and understandable, because if it is too complex, it's just going to be too confusing for you to get the right information, to know that important point of reference. Okay. All right, so let's the other accounts. The important thing to know when you're talking about cost of goods sold versus expense, what is the difference of cost of goods sold versus expense? Cost of goods sold would be anything that is directly related to the services you're providing, and expense could be a more operation expense, such as, cost of goods sold would be, if you are a restaurant, would be all your food supply, your paper good. That's a direct cost of providing those services. And your operations would be rent, would be office supplies, and so on and so forth. So those are usually operation expenses. All right. So, like I said, very important for you to keep it clean and concise. And this is all we're going to talk about today. And we're going to go back here. All right. Okay. Well, I hope that this video was useful. Remember, the chart of account is the most important part of your books, and it needs to be properly organized so that you can see everything on your financials the way you need it to be. Considering the purpose of one, making sure that it's informative for your business. Two, that you can use that information to give to your CPA, and they'll be able to file your tax correctly. All right, so if you like this content and you have not subscribed, please make sure you click the button to subscribe. We come back twice a week with information and updates on QuickBooks Online. We want to help you as much as we can so that you can run your book smoothly and have your point of reference anytime you want to. So you can set goals and run your business and take it to the next level. It is virtually impossible to run a business and succeed in growing without knowing your bottom line. And in order to know your bottom line, gotta keep it organized, gotta keep it clean. You gotta reconcile, categorize it correctly. You gotta create a good chart of accounts, reconcile all your accounts. When you follow all those steps and you have reliable financials, it will help you understand your business and take it to the next level. So hope to see you next time. But until next time, keep on smiling.